From New York City for our viewers worldwide, I'm Matt Miller. Bloomberg Real Yield starts right now. Coming up, U.S. consumer sentiment hitting a 3-year low as the government shutdown weighs on spending, while the Fed's dual mandate remains in contention, leading to further division on the committee, and global bond sales hit a record as Alphabet adds fuel to the binge on debt. But we begin with the big issue, a divided Federal Reserve.
What I see is just a very weird economic cycle.
The growth of the economy is probably accelerating.
What we see is an economy which is likely to slow down from its current pace.
We're in the muddled middle, and that's the issue.
It's been very noisy.
It is a challenging time, and those cross currents of information and data are making it a tough job for the FOMC.
This is, I think, the most divided Fed I can recall.
We've seen a committee that is certainly divided.
It makes sense that they disagree.
Our base case is for further easing.
I'd be really surprised if the Fed doesn't cut.
We do expect one more cut in December.
As the Fed continues to deliver, we do think that bond yields will continue to fall.
You're at a starting point in yields where the return skew is much more in your favor.
The downside seems pretty limited.
We have a softening of the labor market that is quite significant. I think the funds rate should be at 3.
Speaking of the labor market, let's take a look at these jobs numbers. This is the Challenger Gray and Christmas data, and as you can see, we had a big spike up here in October. These numbers are not seasonally adjusted, but it's the biggest number of job losses we've had from Challenger in the last 7 months. If you just look at October alone, if you take only Octobers from each year, you'd have to go back 23 years to find that many layoffs, driven by tech, driven by the warehousing sector. Meanwhile, if you look at the UMich consumer sentiment data that we got today, it dropped to the lowest level on record, matching what we got back in June of 2022 as high prices concern consumers, as well as the government shutdown. A lot of people are not getting paychecks, so current conditions are very difficult. These numbers come with the Fed divided on the current state of the economy.
I think that the Fed is too restrictive. The longer you keep policy restrictive, the more you run the risk that monetary policy itself causes a downturn in the economy.
I remain concerned about high inflation. I see monetary policy as barely restrictive, if at all, and it's not obvious to me that monetary policy should do more at this time.
The current policy stance is still somewhat restrictive, but we have moved it closer to the neutral rate that neither restricts nor stimulates the economy.
Joining us now for our macro roundtable, Mike Contopoulos, Deputy Chief Investment Officer at Richard Bernstein Advisors, and Gargi Chaudhuri, Chief Investment and Portfolio Strategist for the Americas at BlackRock, Chief Investment Officer. Gargi, let me start with you because this is a fascinating debate to me. Whether or not policy is restrictive. We've just had record bond issuance. We have record M&A. We have stock markets at all-time high. Where is policy restrictive?
Matt, it's great to be here. Thank you for having me. All of those points that you made are true, while at the same time, you are beginning to see that weakness in the labor market. You talked about that earlier with the Challenger job cut data, which we got this week. But you're also seeing that broadly, and you saw that even before the government shut down, you saw that moderation take place in the labor market. And I think you can't just look at the stock market being at all-time highs. Not everybody is participating in the stock market. You also have to think about the bottom part of the K-shape that certainly is being impacted or can be impacted by rates being at even the current levels they are at, and also maybe job market getting a little bit softer. So all of that to say that I think rates can continue to move lower, whether that happens in December or whether that happens successively in January to March is yet to be seen.
Mike, what do you think about that? The K-shaped economy is brought up a lot lately. On the other hand, Torsten Slok tweeted out that 25% of America is subprime, and Diane Swank says a rate cut isn't going to help subprime borrowers at all.
Yeah, I tend to agree with that, Matt. Here's the problem is that I don't see how lower rates necessarily affect that sort of lower income dynamic. You know, the channels by which monetary policy work are through lending, and lending standards are incredibly easy. Financial conditions are the easiest they have ever been with inflation this high. You know, a Fed cutting interest rates, I don't think is actually going to be as stimulative as everybody thinks, and will probably contribute to inflation and hurt the lower income portion of that K-shaped economy even more. I would expect inflation to go up in that particular case, consumers to struggle even further. You know, there's nothing about monetary policy that is restrictive at the moment. To your point, you know, you have the most amount of issuance ever this past month. That's not the sign of a tight, you know, monetary policy environment. So I tend to agree with Diane on this front.
So who is going to, or what will come to the rescue of, you know, the bottom half, it's more than half, right, of U.S. consumers? I mean, the bottom 80% seem to be left behind. I saw this week Scott Bessent tweeted that jobs are booming and inflation is coming down. And I wonder, is this government out of touch? Because neither one of those things is true.
So I will say the measured data, and we did get CPI earlier in late October, and that did show some very positive news on services inflation. So what we looked at was that OER component, which, as you know, is a big driver of services inflation. That was a very optimistic print. So all else aside, stock market valuations aside, if you're just looking at the CPI data, and if you compare to where we were and the expectations, now we at BlackRock have an expectation that CPI X of tariffs by the end of 2026 will get much closer to that 2.5%, which point we no longer have to have monetary policy so significantly above that neutral rate of what Fed believes is about 3%.
By the way, this is a great point, Gargi, and I was talking with Rick Reeder about this morning. You guys at BlackRock have an absolute ton of data, right? You have over $10 trillion in assets under management. You have connections to just about every company in the economy. Mike, what do you think about the kind of data blackout? On the one hand, you've got people have their own proprietary data, right? Also, the Fed has 500 economists and 12 regional banks. On the other hand, we're not getting a jobs number today. We're not going to get CPI for October, maybe even not going to get it for November. How does an investor deal in this kind of environment?
You know, there are a lot of alternative data sources. You know, whether it be ADP for jobs, you got the job cuts data, you have, you know, jobless claims, continuing claims. You know, there's all sorts of areas to get alternative data that are pretty good. And so from our perspective, we actually haven't had any problems modeling out where we think the economy is. More importantly, you know, what's going on with respect to liquidity and profits, you know, as that relates to the credit markets and the equity markets. And so there's a lot of alternative data out there. But I do think Chair Powell brought up an excellent point that, you know, when the weather is foggy, you kind of have to go a bit slower. And this goes back to what I mentioned earlier in terms of monetary policy and the expectations for monetary policy. With nearly a 2/3 expectation for a cut in December, that just doesn't make any sense here. When you have an outlook that, you know, is determined by alternative data, it means you have to go slower, and it means you don't do as much.
Gargi, do you agree? I mean, we do have, if I type WIRP go in the Bloomberg terminal, we do see that the market expects a terminal rate of slightly below 3. Rick told me today that he thinks 3 is where the Fed should be. Don't you have to just be cutting continually to get there?
I think you do have to be cutting continually, but at the same time, that may not mean December. So I don't know if they will necessarily have enough data by the December Fed meeting, but I do think they have to get nearer to that 3% level in an effort to be moderating at a time when inflation's coming down and is no longer restrictive. I do also want to point out, you made this point earlier about the IG issuance and the broad credit issuance that's coming through. One of the best things that's happening in the fixed income markets right now is that you're getting that negative correlation between stocks and bonds back. So this week is a great example where, especially yesterday when you had that risk-off move, you did see bond yields move lower. And I think that with issuance coming, the all-in yield being as attractive as it is bringing in a lot of investors into the fixed income market. October, the highest record for ETF flows into the market. And I think that is a huge source of demand that will continue to bolster and support the fixed income market.
By the way, I type INGO on the Bloomberg terminal to see the index browser. It's a very cool function that we've recently updated. And if you put year to date, it's just green on the screen. Fixed income has had a banner year.
It has indeed. It has had a banner year because we focused on the word fixed as well as income. That fixed has moved up and that income has done its job. It's not been about duration this year. If you look at INGO and see where some of the results have come, it is in the higher income producing parts of the market. So EM, which has been one of the biggest drivers in the fixed income market. High yield is another one. And obviously looking at ag and looking at global ag, all of those have been a generator of income, and investors have flocked towards that once again. You don't need a lot of duration in this market, but what you do need is income.
Mike, I don't know if you saw that screen. Are we in the golden era here? It's incredible, obviously, for investors. And there are, to President Trump's point, a lot of people that are invested passively, right, with 401ks. This economy, at least judging by the market, seems to be doing really well.
Well, it's an incredibly narrow market, so it is doing okay, but the market's not the economy, as we all know. Listen, I think fixed income is certainly a very viable asset class. I will agree with Gargi there. The income part of the equation is real now, and it's actually generating a return. So that is a good thing. On the other hand, I would argue that in my 26-year career doing this, I have never seen corporate bond spreads this, or corporate bond investors rather, this complacent. It just doesn't make any sense in our view to own corporate debt right here when you can own, say, agency mortgage-backed securities, which are government guaranteed with a better yield and 2 years less duration. When you can own munis with absolutely a better, a tax advantage yield, but even a better total return opportunity out there. When you can own treasuries, there's a lot of options out there in the fixed income market. You can get exposure to those even through ETFs in a way you haven't been able to before. But right now, I think corporate credit is not the place to be in fixed income. And if I leave sort of with one bullet point for today, I would say that should be it.
Consider it left. Mike, thank you so much for joining us. Mike Contopoulos there of Richard Bernstein Advisors and Gargi Chaudhuri of BlackRock. Always appreciate you coming in. Thank you so much. Up next, the auction block. Alphabet follows Meta's jumbo debt sale with one of its own, this time selling in both the U.S. and Europe. We talk credit next, or continue to talk about it. We talk about it for this entire show because this is Real Yield on Bloomberg. I'm Matt Miller. This is Bloomberg Real Yield. Time now for the auction block, where global debt sales are maintaining their record pace. We start off in Europe, where issuance from U.S. firms in euros, which is known as reverse Yankee debt, set a new weekly record. Alphabet, Bristol-Myers, Verizon, and Morgan Stanley among the big U.S. names to sell debt in that market. Alphabet also helped to lead the way this week for U.S. investment-grade debt. Between Europe and the U.S., the Google owner raised $25 billion, or $17.5 billion sold here, and more is to come as Wall Street is bracing for the busiest November in over a decade. Of course, we got to fund all of this AI investment. All of these sales together help push global bond sales to a record year already, and we're just kicking off November with now nearly $6 trillion in corporate and sovereign debt sold in 2025. Demand is more than matching the debt being sold, with total investor returns for the year sitting at more than 7%. Investors have been happy with fixed income, the best return in 5 years. Wall Street's biggest executives continue to pour cold water on concerns about a systemic credit risk.
You will see challenges in certain companies late in a cycle, but we are not seeing any kind of credit cycle on the horizon that's waning anytime soon.
It's been a long bull run in credit. We had that long period of time of zero interest rates and probably less covenants. But there's nothing systemic going on that we see. We do expect there to see more cracks.
Let's dig into this with our credit roundtable. Danielle Poli of Oaktree Capital Management and Colleen Cunniffe of Vanguard. And I want to start with the cockroach discussion. We've seen, a few what seem to be idiosyncratic blow-ups. Danielle, what do you think about the potential of wider risk?
Well, I think what we're seeing right now is more systematic than systemic. You think about it, high-yield bond defaults, 1% to 2% a year is pretty normal, sometimes a little bit more in periods of stress. And defaults have been pretty muted so far. So what we're seeing is natural. You mentioned the boom in issuance that's coming out. This is the time to stay disciplined, because when there are a lot of opportunities out there and supply outstrips demand, that's when lending standards start getting lowered, and you really have to remain disciplined to get that attractive yield that credit can offer today.
Absolutely. At the end of the cycle, people start to let go. We've heard, for example, reports that OpenAI is doing a ton of deals without even using bankers or lawyers, which has to be a little bit worrisome. Colleen, what do you think? Is this a time where people need to be tightening lending standards, really doubling down in overviews?
I wouldn't use the phrase tightening lending standards. I think it's adhering to the lending standards that are appropriate for the market.
Good point.
And, that's what I think we're seeing right now. We have had a couple of what we're calling idiosyncratic events. What might be notable is that we've had several in a short period of time, and I think that is what got people talking about it. But so what I think, as Danielle said, is that we have sort of a point in the market, a point in the cycle where we're seeing some weak underwriting relative to the standards that might be appropriate to the market. So yeah, it's a time, just like we're doing, to go back to your portfolio, scrub it, make sure that you understand everything you're invested in and that your investment theses still hold up, and but continue to look for opportunities in the market.
Why do we see, Colleen, such tight spreads? And I don't talk to anyone who expects them to widen out. I mean, there's just so much liquidity out there, that so much money chasing each bond, that they're going to continue to hold?
Well, I think it's a couple of factors coming together. Certainly liquidity is a component of it, but as we've talked about in the past on this show, the fundamental picture is still relatively strong, right? Corporate balance sheets are really well positioned in the public markets at this point in the cycle. So that, so you've got liquidity and strong supportive fundamentals, and candidly right now, the spending consumer, let's put it that way, still looks okay. So that dynamic means that people feel comfortable, with where we are in terms of spread. That being said, we are very cognizant that the risk potentially is to the wide side. It's not what we're predicting right now, but it's something we're very aware of given where we are with valuations.
Danielle, what do you think about, what do you get excited about in terms of products out there, offerings, issuance? Do you like the public stuff? Private credit obviously has grown and continues to grow. There was kind of a back and forth between Jamie Dimon and Blue Owl about where the problems are, but what are you interested in?
I'm interested in both. I think when you can complement public and private credit, especially in the same portfolio, you're just getting a wider range of opportunities. We're seeing a lot of convergence in those markets, and I think that's a good thing for both borrowers and investors. Our focus at Oaktree is sub-investment grade. I help run one of our multi-asset credit portfolios, and so I think you see such a wide opportunity that you can be really selective in today's market. So we're thinking about the core of our portfolio being invested in high-quality, high-yield bonds, as well as broadly syndicated loans, and then we're finding some alpha in things like structured credit. BB CLO spreads are still trading at historically wide levels, offering very attractive income. We can diversify our portfolios with real estate-related investments in the structured space, and then also add a little spice with emerging market debt and convertibles. When you put all those together, you've got great diversification to keep your volatility low.
You do see dispersion, though, right? I'm going to ask Colleen in a moment about sectors. And where do you see the dispersion?
I see dispersion, especially in the loan market. So while overall spreads are trading pretty tight at low percentiles, if you look at that CCC bucket, that's still kind of historically wide. You've got average spreads there of 1,200 basis points. You've got to be really careful, especially when you think about the new entrants into the credit space. You know, on average, credit managers have less than 10 years experience, and there's less than 3.5% that have been investing through the financial crisis. So the managers themselves haven't been tested. And so you really want to work with someone that's focused on doing that bottom-up credit underwriting and avoiding the tail risk, because there is significant risk today in the tails of the market.
Colleen, let me quickly ask you about sectors, because you've noted some underperformers in terms of chemical and packaging and some outperformers in terms of healthcare and metals in October. What do you think about now?
Yeah, you know, again, selection is so important in this market environment. You know, on the chemical sector side, we're spending a lot of time looking at that and trying to understand. It's been something of a long cycle there, and we continue to be in an environment where there's a lot of capacity and less demand. What we're still parsing through is that lack of demand an economic indicator, or is it really just the second order kind of impact from how companies approached tariffs? So we're still, that's a sector we spend a lot of time on to try to understand what the dynamics are there. In healthcare, that's an interesting one. There have been some positive outperformance there on the facility side, but we're also really keenly aware of the fact that as we move forward into next year, there's a couple of different things happening in the market, you know, with subsidies and where that stands that may make healthcare more difficult next year. So this is our job. We spend a lot of time thinking about selection, looking at companies, trying to make sure we're picking the best spots and finding the opportunities in these sectors, whether there's outperformance or underperformance.
Colleen, great to have you. Colleen Cunniffe there of Vanguard, and Danielle Poli of Oaktree Capital Management. Thank you very much for the discussion. This is Bloomberg. I'm Matt Miller. This is Bloomberg Real Yield. Time now for the final spread coming up on Monday. St. Louis Fed President Alberto Musalem will be on my program, Open Interest, on Monday at 9:30 a.m. Wall Street time. By the way, we have Cliff Asness from AQR on that program as well. From New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg.